Hello and welcome to my Hargreaves Lansdown Stocks and Shares ISA update for October. In this video we'll be looking back how my investments performed over the month of September and what the big financial headlines meant for my money. If you're new here, then this is a monthly series, so if you want to see any future episodes or any other of my content, then please hit that subscribe button. Thanks. Let's have a recap of what happened in September. September is historically a bin fire of a month, as stocks tend to slump around this time of year. You may have heard the term the September effect, and yes, you may be forgiven for thinking it's the name of some low-budget sci-fi film you'd find on discount at a service station, but it's just a generic term that describes September being historically the poorest month for stocks. Unfortunately, this year was no exception, with the S&P 500 and Nasdaq falling 5 and 6% respectively. Now of course, this isn't just because it's September. Stocks aren't going full Green Day and hiding under their duvet singing "Wake Me Up When September Ends." The factors driving these prices down this time were fears of economic growth in oil prices and bond yields, both rising pretty sharply. October is currently not looking like a strong start either, as sustained high rates are really hitting businesses hard. And it was a similar story here in the UK, with the FTSE 100 having a strong first couple of weeks, only to see those gains written off due to the fears of prolonged high rates. Emerging markets had a pretty poor month, with those high US yields and China's ongoing financial chaos rippling out and making more chaos for less developed markets. This has led to some loss of confidence in emerging markets, as the ones that are performing well so far this year have taken a fairly big hit, and it's starting to feel like no one's safe. This ripple is certainly one I'm keeping an eye on, as new lines seem to be drawn in the sand day by day. The last couple of years have seen a rise in proxy wars, and I think as much as it's nice to believe a big nation like the US, for example, would like to stick up for smaller nations that have their sovereignty at risk, when you look at what resources those nations have, it paints a slightly clearer picture. It may just be coincidence that the territories that are either being fought for or are under threat from other nations can certainly help to make other nations financially secure in the future, but I'd be surprised if it was. Proxy wars can easily escalate as either side becomes more desperate, and let's face it, if it's got to this point there must already be some desperation, so this greatly concerns me. Now this is of course worst case scenario stuff, and I hope conflicts never break out, but to me it looks like there is a trend here, and with recent leaks out of Russia and NATO's comments, it looks like both sides are prepared for a long conflict. It shows to me just how serious countries are getting over protecting future resources. Let's start taking a look at my portfolio. My portfolio is very exposed to the US markets and marginally to emerging markets, so you'll see the impact on those soon. First though, we'll look at income. In September, I continued a fairly strong year in terms of dividends, with £24.67 being paid to me by Legal & General. That dividend will be reinvested back into Legal & General, but we'll take a closer look at that in a minute. I also received 47p in loyalty bonus payments. Still a long way off the £10 needed for those to be reinvested. With that Legal & General dividend, it keeps my monthly average income above the £10 mark for this year, or if we look at the 23-24 tax year, it puts me at an average monthly income of £16.84, and takes the total to just over £100 earned so far since April of this year. Not bad at all for a small portfolio that isn't even weighted towards income. Looking at my portfolio on the whole, it's still looking pretty healthy, with just over a 5% return. But when we start looking at the charts on my individual holdings, you'll see that most had a much better time in the middle of the month, and then came crashing down amid the fears we touched on earlier. My UBS S&P 500 holding shows the drop pretty well. I think it clearly shows just how quickly confidence can be lost. This isn't the only US focused holding I own. My two Fidelity funds are too, and also show the same picture, which is hardly surprising as there is a lot of crossovers with these funds. They hold a lot of the same companies' stocks, and is something I've been looking to tidy up a little. At the minute I'm thinking of selling off a chunk of one to buy into something new and continue my journey of diversification, so this latest dip in the US markets really hasn't helped me here, as I wanted to capitalise on the previous gains to get me a decent chunk of my next purchase. What I may well do instead though is sell off my stake in Centrica. They've been in the news a bit recently as analysts think we've seen the most of the upside to this share, meaning it doesn't have anywhere really to go from here other than hover around this price or drop a bit. I've had a decent return from Centrica, currently just over £100 increase in value, albeit on a pretty small amount of shares. If I do sell it, I'll be left with just over £240 after fees have been taken off, which will go a decent way towards my next purchase and mean I won't have to take so much of a hit on one of my Fidelity funds if I choose to sell off some of those. Centrica is due to go ex-dividend on the 5th of October, so the price will likely drop after that. I may wait and see if it bounces back a little before selling off, but this could be risky. I don't want to wait for the price to rise while the price just falls off a cliff. Timing here will be key. We saw earlier the dividend I received from LGen. That will be reinvested in the second week of October, so we'll see next month how many units that bought me. Historically, it's bought me between 8 and 10 extra units. All of that of course means I should see a decent payout for the next full dividend. LGen is being hit hard by the high interest rates, and as there doesn't seem to be any light at the end of that tunnel, the share price has been very low for some time now. I'm not too fussed. It would be nice if it bounced back, but then if the share price was higher, it would mean I wouldn't get as many units when my dividends are reinvested. And as I'm looking for the long term with Legal & General, I can suck up the poor performance for now and look at the bigger picture. I'll run through my remaining holdings now briefly so you can take a better look. I've not looked at Rolls-Royce this month, as I think the next couple of months will be decisive. They'll be providing an update on the 28th of November as to their strategies moving forward. This could send the price soaring, or it could be a bit of a fizzle. I for one cannot wait for it though. But that's it for today. I hope to see you next time. Stay safe out there. Peace.